All right, you little monsters, welcome back to class. Today we're going to continue learning about bank balance sheets. We're going to do a couple practice problems today. So here we go.
We're in here talking about practice.
All right, so here we're going to look at this bank. Remember, every time you start one of these bank balance sheet problems, the first thing you need to do is you need to figure out what the demand deposits are. That's the most important thing. You find out what are demand deposits. Right now, this bank has $100,000 in its demand deposits, aka its checking accounts. So in this checking account, we got $100,000 in this bank. Second thing you need to do is find out what the required reserve ratio is. This problem doesn't give us the required reserve ratio. It just makes us figure it out. So if we look over here, we have no money in our excess reserves. So because we have $0 in excess reserves, we can conclude that this bank is only holding on to its required reserves. So if we have $0 in excess reserves and $50,000 in our reserves period, that means we have $50,000 in our required reserves. $50,000 is half of $100,000, and that means that our reserve requirement ratio has to be 50%. So our reserve requirement ratio currently is 50%. What is the current value of excess reserves at Taytay Bank? Well, if we look down here, it just straight up tells us our excess reserves are $0. Because our excess reserves are $0, and the excess reserves is where you get loans from, the value of new loans that Taytay Bank can make is $0. You can't loan money out if you're only holding on to the bare minimum that you are required by law to hold on to. This bank is not allowed to loan out that $50,000 because their required reserve ratio is 50%, and that's all they're holding on to. They're holding on to the bare minimum. They cannot loan out another dime. Next, we can calculate the money multiplier. Remember your money multiplier formula, let's write it down right now, is going to be 1 over the reserve requirement ratio, or 1 over the RRR. Right now, that would be 1 over 0.5, because it's 1 over 50%. Oops, that's not what I meant. 1 over 50% in decimal form. Half goes into a whole 2 times. And so our money multiplier right now is 2. We have a money multiplier of 2 at the moment. Okay, now one of my friends is going to come in. Mrs. Sandrin is coming in, and she's depositing $200 into her demand deposit account, aka her checking account. What is the maximum increase in the money supply possible if Taytay Bank wants to hold no excess reserves? All right, so she put $200 in her demand deposit account. Taytay Bank has to hold on to, so our required reserves, we have to hold on to 50% of everything. So our required reserves right now are going to increase by $100. I have to hold on to $100 out of that $50. That means that my excess reserves have now increased to $100. So Miss Sandra came and put in $200 in her checking account. The required reserve ratio is 50%, so I'm required to hold on to $100, 50% of that $200. I can loan out, or I have an excess reserves, an extra $100. So what we got going on here? We need our multiplier, so our loans are going to increase by $100, and that will allow our money supply to increase by that $100 times our money multiplier of 2. So if Taytay Bank loans out every cent that we're allowed to loan out, and the money multiplier is 2 because we have a 50% reserve requirement ratio, then this deposit of $200 can turn into an increase of up to $200 in the money supply in total overall. Because remember, a loan is going to increase the money supply. A loan is the creation of new money. And so if everybody that takes out these loans keeps putting the money back into their checking account and their bank's loan out every last cent that they're allowed to, money supply can increase to by up to $200. Now we have the Bank of Strickland Land. The Bank of Strickland Land is located in a country that currently has their central bank setting the reserve requirement ratio of 25%. That means that Strickland is going to be able to loan out anything above that 25% required reserves. So right now, in demand deposits, Strickland Bank has $80,000. So there's $80,000 in the demand deposits in Strickland Bank, First Bank of Strickland. Their reserves right now are $80,000. So their total reserves at the moment are going to be equal to $80,000. Oops, too much. And that means the required reserves then, required reserves are going to be equal to $20,000. 25% of $80,000 is $20,000. 80,000 times 0.25 is going to equal $20,000. Oops. This bank has to hold on to $25,000 at the moment. So again, 80,000 times 0.25, that'll help you out. All right. So that means that in their excess reserves, they currently have $60,000. This bank has $60,000 that they are allowed to loan out. I don't know how to spell. Okay, so if they have the ability to loan out $60,000 and the reserve requirement ratio right now is 25%, well, our multiplier is going to be 1 over the reserve requirement ratio, and that's going to equal 1 over, right now, 0.25. 25 cents goes into a dollar 4 times. So our money multiplier is 4. If we increase loans by $60,000, our multiplier of 4 times that $60,000 is going to turn into, what's 4 times 60? 120, 120, 240. That could turn into up to $240,000 increased in the money supply. So this could be if Strickland Bank loans out all $60,000 that they're allowed to, their multiplier is 4. That could increase the money supply by up to $240,000. So now that we're done with that, we've got a little bit of practice in. Tomorrow we're going to talk about an FRQ. I'm going to bring up an FRQ and we're going to be able to work our way through it. So now I'm going to take off, no offset. Goodbye.